Okay, hey, thanks, Jeanette. Well, hey, everybody. My name is Ron Haydt. Thank you guys for coming, and thank you for Jeanette having me on. As Jeanette said, I've known her for quite a few years as well. We get along quite well. If you never met her, she's awesome in person, and whenever they ask if I'd be interested, the answer is always yes, because I enjoy our relationship a lot. What I'm going to talk about today is fixing broken trades, just like the emails said. But if you ever see me in a presentation, you know I always have to show a disclaimer that nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. Now, I have about an hour here, so I put together this PowerPoint. It's one of my most favorite ones to deliver because it's essentially timeless. Oops, I'm going to stop right there. Now, I'm going to give you about a 20-second intro on me. Basically, started trading my career back in 2000. I essentially did everything wrong humanly possible. It seems that I like pain. So as I went through and tried to learn, I found that a lot of the education that was out there at the time I was learning and so forth was almost as if it was made to make the author sound really, really smart. And while I may not be the sharpest tool in the shed, I think I can handle my own. And I just found it so difficult. So when we built Market Tamer, we wanted to make sure the exact opposite was going to happen. That if we go and build something to help people become more proficient traders, that you don't need a PhD in everything, in math or whatever it might be, to get through it. So we try to keep it simple, and that's my goal today, to keep things very, very simple. If you guys have questions as we go along, feel free to ask. I don't mind at all. I will answer all your questions at the end. I expect to do about 45 minutes here and then like a 10-minute Q&A before I hand it back over to Jeanette. So again, this is my favorite PowerPoint, I think, of all time, because it's funny too. All right, so to introduce the topic of today's session, we're going to talk about accidents. So if you have kids or maybe you skateboard, I don't know if you know, but Jeanette is a fantastic skateboarder. Accidents can happen. Car accidents can happen, or I'm just going to say ouch. And since I met my wife, she pretty much demands, there's a cat picture in almost every PowerPoint. I try to adhere to that. And we know as traders that, stock market accidents can happen too. So no matter how often you've traded, even if you do everything you're supposed to do, every once in a while you might make a mistake. And the one that I like to use is back when Facebook came public. And we bought it as a tracking position to show our members, all from an educational perspective, okay? And here's what I call the worst part, because it is a bit funny, because we succumbed to pressure. And we said, listen, when a stock typically comes public, that's when the smart guys are selling, and that's typically not when you want to buy. It doesn't mean the stock can't go tremendously higher, but if you're looking for pretty much a great opportunity to get in, it's usually not the day it goes public. And if you think back to Facebook, that's exactly what happened. Because if you go back to and because we are getting quite frothy in the market, you think back a decade ago when Blackstone went public, they were actually talking about, you know what, everybody's coming out from underneath the rocks, if you will, and trying to make some money. And what happened? The market ended up crashing. Blackstone went down. I might have said BlackRock. Blackstone got crushed initially before it rebounded. So when Facebook went public, okay, we said, listen, this might be a phenomenal company. Nobody can really see 10 years or 5 or 3 years into the future, so to speak, and be exact, but we're probably going to be bullish on it, and pretty bullish. But in the interim, not a chance. They usually don't work out that way. So when the stock hit 45 bucks, we said, listen, we're just not going to touch it. Why would I pay 45? And we're actually on record saying it's probably going to go into the 20s. I mean, at the current time, the valuation was absolutely pure insanity. And so we said, no, don't buy it. And at that time, Apple was the #1 stock in our community. Everybody was talking about Apple. They pretty much still do today. So when it dropped to 40, emails or if I'm on a webinar with our members, people started saying, hey, it's down 10%. You always talk about Buffett buying on weakness, right? I'm like, yeah, but okay, 45 to 40 really isn't weakness. So then I hit 35. Oh my goodness. Then we're getting barraged with comments, right? Why aren't you buying Facebook at 35? I'm like, there's no indication on the chart whatsoever that it's a buy. And then it got to 30. And we literally said uncle to the community, because they said, our peeps, our people, hey, you guys always talk about being able to fix broken trades. So why don't you put your money where your mouth is? You know, it's sort of like, I guess an analogy would be taking Usain Bolt. And just because the dude can run fast and probably outrun the lion, why would you do it? Because if you trip, you're going to get eaten. We said the same thing. There's still no indication there's a bottom, but we gave in. We said, fine, we're going to buy it at 30. 100% wrong, because what happened? The stock went down into the 20s, just like we figured it would. Now, we weren't sure, but one of the things that we like to use is very, very simple chart analysis. Look for, I don't know if you guys are candlestick aficionados. I love candlesticks. Gosh, if there was just two things that I could trade with, volume and candlesticks would probably be my two favorites. But we said, let's just wait. Let's see the whites of their eyes. Let's see something that says it looks like the big money is going to come in and try to support this stock. You know, just because you can go out and pay list price for the latest, you know, Ford Mustang, why would you when you know you can get a discount? Make sense? You know, that's why we waited, but then we gave in. And what happened? You know, we started accumulating here, and the stock does go down in the 20s, just like we thought it might. But here's the thing, and this is what our members were telling us: because you guys can fix trades, we want to see it in action. Now, I'll be the first to tell you that not every trade can be fixed, because we have to remember that, you know, taking good money and throwing it after bad is just not the best decision in the world. And I think we probably all know that. So I'm not going to sit here and tell you we're going to fix every one. But if I can take a losing trade and get it back to break even, this is going to sound super corny, but we're going to win by not losing. And then if I can take some of those losers and get them back to break even, I mean, it can make a monstrous difference at the end of the year. So why are we so sure we can fix them? We've done it before. We use a really simple but hugely powerful method, and I'm going to share that with you today. You guys are welcome to take pictures of the screen and write it down. And one of the first questions I'm going to get asked is, well, does it work on every stock? The answer is no, it will not. Nothing's ever perfect. I can't promise you it's ever going to work again, but it is basically a pretty gosh darn good one. And if you use this, what I'm going to show you, and you back test it against some of the stocks you have, I think you're going to quickly start culling the herd on some stocks that you guys are trading, because you're going to say, man, these little buggers do not conform. I want stocks that conform, because if they do, it gives me an edge, in my opinion, that I can sort of have a greater level of confidence on what that stock might do next. I don't like stocks that are jumping beans. I like trenders. So in this session, I'm going to share with you how you can recover from a really bad trade and turn it potentially back into a winner. Because why? You do it everywhere else. Think about it. If you have an accident, you go to the doctor. If you have a pet, you go to the vet. What happens if your stock market has an accident? Well, you know, whether you're a mechanic fixing a car, pilot flying an airplane, you got to have a plan to fix your portfolio when things go wrong, because you know it will. Whether you're Homer, whether it's Murphy's Law, you know that at one point you're going to have a bad trade. Would you really let a pilot fly a plane without knowing what to do if things go wrong? You know, if your foot hurts, would you go to a heart doctor? Probably not. So why on earth would you risk what you've worked your whole life for, that nest egg, without having a plan in place to implement if things go wrong? The reason you can be pretty sure things are going to go wrong, nobody has that crystal ball. So even though you're going to do tons of research, maybe it's technical. I love technical analysis, by the way. You know, you read charts, you use everything imaginable, use fundamental analysis. Sometimes those expectations, they're going to be wrong. And believe it or not, this might sound really obvious, but I call it a privilege from training people all over the world, tens of thousands of people. But truly, when you can admit to yourself that you will be wrong and just say, I thought this was going to happen. Okay, it didn't. Now how am I going to fix it? That's truly a turning point, because then you can embrace that idea of saying, you know what, I'm wrong. I'm not going to get married to this. Let's go fix it. And for that, we need a trading plan, because when, X happens, we do Y. When Y happens, we do Z. We really want to be robotic with our trading. While it's nice to have, and I would recommend probably getting a trading buddy, someone to keep yourself honest. But once you have that trading plan, we got to stick to it, because without it, we have these two little gremlins sitting on our shoulders. One is greed, buy, 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 hold, hold, hold. And the other one is sell, run for cover. And before you know it, your head's just spinning. And then you have paralysis analysis. You're a deer in the headlights and you get run over. And that's not what you want. I think we've all been there. So without a plan, it's pretty easy to take losses on a regular basis. But what if we could turn that losing trade into a winning trade? Think about all those losses that we had. I know tax season's a while, is a ways off. Just think back to that last time, and you looked up all your losers, and you're thinking, man, if I just could have salvaged this, I actually might have had a pretty gosh darn good year. And if you can take that $1,000 swing on just one trade, it's actually a 2K swing in the portfolio. If you have 10 grand in your pocket, that means instead of being down 10%, you're up 10%. Take all those thousands of losing trades and start thinking each and every one, if we could just turn some of those, how much of a massive difference that could have been, how much extra money we might have. All right, so it's better to not lose, duh, right? So how do we do it? There's going to be two key ingredients: patience and discipline. Whether you're a golfer, tennis player, football player, you don't just get great by just training for a weekend. No one's going to get rich overnight. And while it is possible to get rich overnight, you got to take on a whole lot of risk, and that's just not smart. So at Market Tamer, we're okay taking risk, but we want to keep it controlled. We want to keep it fixed. We don't get overly aggressive. And I would say, think of your nest egg the same way. Yes, we want to grow the nest eggs, but we want to do it in a very controlled environment. So I'm going to take you through an example, step by step. We're going to have some fun. I'm going to pop out the little question box here, and I think you're gonna enjoy it. So we're going to talk about taking a loser and turning into a winner. Please do take notes. It'll be clear, easy, repeatable, step by step. So I just like to call it fixing a broken trade the Market Tamer way. So here we go. Let me pop out the little question box so I can see what you guys are doing. And there we go. Just going to slide this over just a little bit. Now we're going to have some fun. All right, let's imagine, and I purposely blocked out the stock symbol. Okay. Let's just say that we're going to buy a stock at $72 a share. Now, if you look on the left, you should be able to see my mouse moving around. The stock had gone up, the stock had gone down, and the stock has been moving up. I think the stock looks pretty good, and we're all going to agree for fun that we are going to, what? We're going to buy some shares. Now, I want to point out these two moving averages. There's a lot of different things out there. I do like Ichimoku, not the Rash, but the Cloud. I like moving averages. I like Fibonacci's too. But to keep things super simple and something that you can readily find, literally on any brokerage, are these moving averages. So the blue line is the 5-day EMA. The red line is the 20-day EMA. Now, these are exponential moving averages. All that means is they're going to be a little more closer to where the stock is moving. If you use a simple moving average, an SMA, each day has the same weighting. When you use exponential moving averages, the EMAs, it gives the heaviest weighting of that calculation to the most recent price action. I like that better. If you said to me you hate that and you prefer SMAs, I really don't care. It's not going to make that much of a difference. But let's just use EMAs because they're my favorite. And again, you can find these at any brokerage. So how stocks are viewed when you use these moving averages on a daily chart. This is a daily chart. When the blue's above the red, it's considered bullish. And the stock is generally going to be moving in an upward direction. When the blue is below the red, it's generally considered bearish, and the stock's going to move in a downward direction. When that blue line crosses down through the red, as in the white circle, that's considered a sell signal. Just like over here, it's considered a buy signal. I just want to stop here for a second. We are getting a sell signal. We're going to go buy a put, which I'll talk about here in a moment. Earlier, just a few minutes ago, I talked about stocks having repetitive patterns. Symmetry, chart symmetry to me is very important. Let's just pretend that we all love trading Google. And if Google looks like a jumping bean on a sugar rush, and it is all over the place, I can't trade that. However, a stock like this, that moves up and down, there's ebbs and flows. And predominantly, these blues and reds cross on a regular basis, and there's some consistency to the follow through. This gives me a tremendous edge having an opinion of where this stock is likely to trend. So the most important thing to me is I like money. I really don't care what the stock is. So maybe you love Nike and Dick's Sporting Goods. Don't really care. I want the ones that move. I don't care if it's a drug stock. Well, I actually don't like drug stocks, but if it is a drug stock, so be it. If it's a cigarette stock, so be it. If it's Starbucks, I don't really care. You get the point? I just want symmetry to make more informed decisions. Because after all, I need to protect my money. And I want to do that with the greatest level of confidence. So what's happening right here? We are about and are getting across. So we said we're going to buy 100 shares of this stock at $72 per share. So the 5-day EMA is now crossing below the 20-day. That is a sell signal. Now the stock's at 68. Long puts are typically purchased to what's referred to as ATM or NTM. ATM means at the money, NTM means near the money. Essentially, hey, near where the stock is trading, we're going to buy some long puts. And just for, practice purposes, usually 90 days, about 3 months, is pretty adequate for most situations. I don't need to go out a year, although I could, but buying something on a weekly basis or just 1 month basis, it's really susceptible to time decay, which is referred to as theta as well. And I just don't want to do that. So 3 months is a good average sweet spot. All right, so what's happened here? We bought stock at 72. We bought strike 70 puts at $5 a share. So how does this play out? Well, from a cost basis, 72 plus 5, that's our cost, $77. So if I have 100 shares, it's 7,200 plus 500 equals $7,700. But my risk is very small in comparison. What's the risk? Well, we have a $77 cost basis, but what does a long put allow us to do? Now, if you're unfamiliar with that, long puts are called insurance policies as well. They allow you as a put holder to dictate what's going to happen. That means even if this stock went all the way to zero, you get to go sell it to someone at 70. It's just the way it is. That's going to make that other person feel pretty crappy probably, but who cares? You have to protect your money. That's why you buy the insurance. So even if this stock that we purchased at 72 goes to zero during the time we're holding our long put, our risk is a measly $7 a share. And that's huge. For people that held Enron, WorldCom, Global Crossings, all these companies, or Sears, JCPenney, the list does go on and on. How about Chipotle? This is a great one for Chipotle. If you were with us or just understanding this simple methodology, you should not have been tacoed by Chipotle. Not a chance. The signs were there. The risk should have been dramatically cut down. All right, so if you're all good, we're going to keep going. Risk here is $7 a share. Now, we're fast forwarding. Take a look at this chart. I'm going to take you back. Right here, where that little red arrow is, that's where we purchased the long puts, right when that blue line was crossing down through the red. The stock has since trended lower, 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 and lower. Now we're at the circle on the right. It's right around 60-ish, $58. I have a question, and I would really love for y'all to play a part of this. Here's my question. Should the long put be closed? Meaning, let's cash out the long put and take the profit. Because here's what happens if you're not 100% sure how long puts work. As the stock is dropping, the long puts are gaining in value, but the stock's losing in value. It's a trade-off. And if we're all honest with each other, how many times have we bought a long put, saw the stock go down, and then we held a long put a little too long, then the stock rips up, and then we lose all our profit in the long put? We've all been there, done that, right? So there's a lot of times that you feel gun shy, you feel quite timid, that you do want to sell these puts back. You want to take the profit you made because you know darn well one big up day and all the profit from that option is gone. I get it. Plus, check out over here on the left. The stock's hitting support. So do we want to sell this? Yes or no? All right, a few of you guys are typing in. We got a yes, 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 no. Vin is saying something different. We have another no. Richard's saying something different. And P's saying something different. Nigel, yes. Jim, yes. Richard, yes. Okay, thank you for participating. OM is saying something different. Fred's like, I'd sell it. Ranganathan, is there a trailing stop? We'll see. Thomas is no. Harbons is yes. Roger, Patricia, yes. Patricia, yes. MR, sell half. Very interesting. Stephen L is saying something else. Okay, cool. As you'll notice, I said yes, no, and something else. I gave you one small piece of information earlier when we first kicked off. And if you think back to that, it's probably going to play a role in your answer. And I'll tell you what that is in a second. Okay, if you decided to bank profits, meaning you sell to close the long put option, you just found out that you are more aggressive by nature. You decided to hold the long puts. You just discovered that you're more conservative by nature. So we have two answers here. We have the aggressive people who said, man, I'm cashing this long put out because I've seen this story play out before. I want that money. Then you had the other group of people that said, nah, I want to hold it. I don't know what's going to go on here yet. Okay, neither one of you is wrong. You're both right. You just found out what kind of trader you are. ... However, I said this was a nest egg. It's like, oh. So if I assume that this is nest egg and it's money we cannot afford to lose, when I actually present that question to you in that way, what typically happens is I get a lot more, oh yeah, we want to hold this, right? Because it is the nest egg. But if this was a small position, could I sell it and capture the profit from those long puts? Sure, of course we could. But if I take the conservative approach, nest egg approach, I'd probably want to hold it. Now here's a key. Remember how I said back here in the center of your screen, we were on a buy, and then over here we bought our put, we were on a sell? The blue line did not cross up through the red line. Never happened. So there was no bullish crossover. Oh dear. Down we go. Here was the previous point on the chart. We ran right into those moving averages, and then like the bottom just fell out. The stock drops nearly $10 more. So the conservative traders were vindicated. But now we come into an interesting situation, because there were a few people that they said something else. And what some of those folks were saying is like, we could roll down the option. We could cash out that put and buy a new one. Same thing. What usually happens with stocks, not so much ETFs, right? But with stocks, there's going to be earnings reports. It's that E word. And now that the stock is all the way down at 50, and it's still bearish, we really do not want to hold those strike 70 long puts in case the earnings report is really positive and the stock jumps substantially higher, because that would wipe out a lot of profit with those long puts, which is why so many folks said, yeah, let's sell that put early. I get it. But at the same time, if this is the nest egg and it's money we really don't want to lose, we can't go through earnings without a protective instrument in place, because if that's a large position in the portfolio and that stock gaps lower, we could be decimated. So to resolve this dilemma, we're going to do what's called rolling. We're going to simultaneously close the strike 70 long put and then buy to open a new long put at a lower strike price. Let's say strike 50. It's just called rolling. We're rolling along. So what happened here? If you look at the bottom of the screen, we paid $5 for that long put up at strike 70 initially. We sold it for 20. We're up 15. Now I know what you're thinking. Wait a minute. We bought this stock at 72. It's now at 50. My math says $22 loss. Well, you're absolutely correct. The put only gained 15. It was never meant to gain dollar for dollar. It was just meant to sort of save our bacon. So are we still down $7? Yeah, we are, and that's okay. So let's talk about our new adjusted cost basis. I'm going to save us some time here. So new cost basis, $72. That was our original purchase price of the stock. We're going to subtract out $15 because that's how much the long put made, profited. But then the new long put that we're going to buy down at strike 50 is going to cost us about $3. And by the way, these are pretty real prices. It's not like it's pie in the sky numbers. They're pretty accurate. So now if I do this math, my adjusted cost basis is 60 with the stock at 50-ish. I'm still down $10 a share, and I'm walking into earnings, okay? This is okay. This is natural. So what happens? Oh dear, the stock did gap up. Whew, thank God we got rid of those puts, right? We rolled them down. Otherwise, we would have given back potentially $10 in profit on that put. Now the stock's up here. Now, for our math example, we're going to assume those long puts are now worthless. So we're just going to eat it. And look what happened to the stock. Zoom, zoom, zoom. It's like a Mazda commercial, right? It comes down, pulls back, and goes up. We never had a blue and a red crossover. That's a pretty amazing run. So why did the stock do this and then this? Ebb and flow. Maybe it's seasonality. Maybe the company just ran into some supply issues. I don't know. You never know why stocks are always going to go up and go down, but they often, you've heard of sector rotation, which in a way is seasonality too. Maybe that's what happened here. So I like to do a comparison for you. How did this little adjustment strategy work out? Well, if you were just a buy and holder or buy and hoper, you had a higher cost basis of $72 this entire time. You probably suffered a lot of stress. If I go back to this slide, please go ahead and be honest. We're all friends here. Right there, we bought. How many people have bought a stock and literally the very next day, it's already started going down, as if everyone knew you were the last sucker to buy the stock? I'm going to raise my hand. We've all been there. We've all done it. And it's going to happen again. It's inevitable. That's fine. It starts dropping. But then we buy puts. But if we didn't buy puts and it kept going down, I mean, a month or two later, the stock that was at 72, now you're at 62. Oh, crap. Now you're at 58. Now you're at $52, $54. Now you're looking at the earnings report. So how many people have done this? We buy a stock at 72. We watch it go down to 52. Right before earnings, we say, oh, I am the worst trader in the entire world. I will never do this again. I promise myself that, we go to our spouse and we're like, listen, I'm an idiot. I'm so sorry. I should have had a stop loss. I didn't know what I was doing. But the company, it just had such great fundamentals. I mean, it even pays a great dividend. I don't know why it went down. It made no sense. And then what do you do right before the earnings report? You look in the mirror and you say, well, I had, if you bought 100 shares, it was $7,200. Now it's $5,200. $5,200 is better than nothing because clearly everybody else knows something I didn't, and that's why the stock went down. I'm going to go sell the stock before 5,200 becomes 2,200, right? And then magically the stock goes right back up after you sell it. And then it goes right back up to where you were. Here's my point. If that was you, by the way, been there, done that, got the t-shirt, and that's exactly what Ed's just said. Ed S. You were losing sleep, you're beating yourself up emotionally, just not happy, and then you went and maybe you sold, and then you're really not happy now. Instead of doing it that way, why not buy a long put, write it down, sleep like a baby, readjust the put before earnings, and then all of a sudden you look like a bit of a rock star, and you say, I might actually know what I'm doing. Again, been there, done that, got the t-shirt. So the buy and hold people, they probably have a lot less hair. But how about what we call the married put adjustment process, which is we buy the stock, we buy a long put. That's the example we did today. How did that play out? Well, we're profitable by 12 bucks a share. Net, remember, we made $15 on the initial put, but then we paid $3 for a new put. And that new put would have expired worthless. So I have to subtract that 3 from 15. That's how I get 12. So our put made, if we do a 500 share example, $6,000. We made $6,000. We had a lower cost basis of 60 bucks, and we slept like a darn baby every single night because we knew even if that little stock went to zero, what our risk would have been. Now look at this. Here's where we did a tracking position. There we bought the put in the green circle. Down at the bottom of center of your screen, we adjusted, rolled the long put down, cashed out the puts. Stock went up, never gave a sell signal, and now it's at 90. Are you kidding me? With the stock above 90, the return on risk was over 50% in 7 months. This is not with a call or a call option. This was with stock and long put only. So we're talking about 50% on a large investment, not a call option investment. That's huge. Now in that example, oh, by the way, I just want to say one thing to you. This happens a lot in the market where you think a stock should be going higher, it then goes down, and then it runs at the exact opposite time that you think it will. So were you right in buying the stock here? Yeah, you were. Your time frame was just off. And that's okay. When I walk into a trade, especially longer term trades, I don't presume to think that I got all the answers. I don't know what the market's going to give. There could be something geopolitical. There could be something with the Fed, whatever. Maybe I just didn't look at my, enough homework or the seasonality of what the stock may or may not do. And it just starts crashing. It was just the wrong time. Did the fundamentals change? Maybe there was no bad news. There was nothing wrong. You didn't do anything wrong. It just was the wrong time of the year. Then the fundamentals took back over, and then she starts ripping higher. And if I told you what this stock was, which I won't, because I like to keep it a little secret, you would say, OMG, you're absolutely right. By the way, this is a phenomenally rock solid company, and the share price is hundreds of dollars higher. Pre-split. It's just a period of time where it went down. There was nothing ever wrong with it. So in that example, we only looked at employing the long put option to lower the cost basis. That was it. I know what some of you guys are thinking. Could we have done something else? The answer is yes. Here's one thing I really like to teach, and that's using covered calls. When stocks give technical sell signals, and I like to use the 5 and the 20-day crossover, we can start looking at maybe using short call options. Now with weeklies being so prevalent and certain stocks have tremendous liquidity in those weekly options, we could do weekly short calls. We could do monthly short calls. We could do quarterly short calls. In this example, let's just say we use a 3 to 4 month call and we take in $3. So we're not really trying to make a ton of money here, but something. Let's just sell a call as it goes down. By the time the stock finishes going down, we then cover our short call. We buy it back. It's essentially a penny or a nickel at that point. So now we take our short call off. Why would we do that? Well, when we got the sell signal, the stock was trending down. We're putting extra premium in our pocket. But before earnings, we're going to pull back that call, take it off, so we have unlimited upside potential. And there we go. So we have a couple simple rules. Rule of thumb, when the stock is in a downtrend, when you get those sell signals, we can consider selling short calls. When technical levels fail, support's broken, etc. If you want to take it that far, we can then sell calls against our stock. Now, we typically do one short call to every 100 shares. We never want to do more than one short call per 100 shares because that's trading naked. And there's a lot of things that, it's a little joke, it's a Saturday, I can say it. There's a lot of things we can do naked, but naked short calls will not be one of them, just because of the unlimited risk factor. Now, prior to earnings, we do typically like to buy back our short calls, especially if the fundamentals have not changed. Now, if the fundamentals have changed, maybe I would leave some short calls in place. But if you go back to the very beginning and you think about this, the reason we typically would buy stock for the long term is maybe we hope to have dividends. Maybe we believe the company has great fundamentals or will have great fundamentals, and it may have tremendous growth opportunity. So as long as none of that really changes, just because the stock goes in a downtrend, I don't want to sell my shares. It's really hard to time the market like that. Sure, it can be done, but it's not the easiest thing in the world to do. Therefore, if I have a stock that's fundamentally sound and I like it, I'll just buy a put when it goes down and then add short calls when necessary. So selling short calls against our shares means that our percent return on risk increases because the risk is declining as the calls are sold. Now we're profitable by $15 a share. Remember that we were 12 bucks on the put. Now we add another $3 for the call. Now our cost basis, instead of being 60, it's down to 57. You can see how this keeps getting better and better. One quick question I get asked is, will I always be right with my puts? Will they always make money? The answer is no, nothing ever works all the time. Will the short calls always make money? The answer is no, nothing ever works all the time. But in the grand scheme of things, it's incredibly powerful. That's why we want stocks that trend. I don't want stocks that look like jumping beans on the daily chart. So now you know how to fix a broken trade, even one that goes entirely against your expectations. What I want to do, though, is do a second one. I want to talk about how to fix a spread trade. Just give me one moment. I just need a quick drink of water. All right, thank you. So let's talk about what happens if you're a credit spread trader. And just to hit one question, actually a couple questions. Real quick, hey there, Ed, how you doing? Ed wanted to know, before I get into the spread trade, in the stock chart we were looking at, why not try to buy calls? So let me just back up a second. I think this will be really nice to do it right now. Let me just scoot. So what Ed is saying here is, hey, when you get across to the upside, why not buy calls? Ed, I love that idea because of how this session is and trying to keep everybody on point and keeping a consistent theme. I don't want to go into all those details, but I absolutely love that idea. It's more aggressive. Hey there, Amit. Your question was, hey, should you check fundamentals if you want to invest? I think so. There's a lot of great research sites out there that offer fundamental analysis. And P, your question is, the red and the blue, just wanted me to make sure that P understands. The blue line is the 5-day EMA. The red is the 20-day EMA. So blue is 5, red is 20, and they're both EMAs. All right. I think we are back up. So let's go talk about spread trades. Now, this example is pretty neat. I've blocked out the symbol because it doesn't really matter what the stock is. At Market Tamer, we also have something called the MT cash flow system, and it gives out credit spreads, which I think are fantastic strategies to use, even in low VIX environments. So we're just going to call it XYZ, and it was listed as bearish. We're given strike prices. The expiration I have blacked out on purpose because it's irrelevant. They typically last 45, 90 days, but again, it doesn't matter for us today. We're given a specific credit number to target. Okay, so let's go look at a chart. So here is XYZ. If you zoom in, you can see it was lower left here, moving up. Then it gets into like chop suey a little bit. And where that green arrow is, that is where the trade idea was initiated. So we have our bear call at 85. The stock's trading down close to about $81. So it's about 5% above where the stock is trading. And what happened? Well, the stock went sideways, then it dropped to almost 79, then it's up to 82, then it's to 79, then it's to 80, then it's to 79, then it's to 80. This is, by the way, if you do not know what bear call spreads are, that's perfect. Going nowhere fast. That allows time decay to erode from this trade. Everything's looking great. Then all of a sudden, pop goes the weasel, and this stock just goes nuts. It goes from around 82 bucks all the way up to 88 bucks. Huge move, like 8%, Well, that's pretty crappy for a bear call spread. Now this trade is losing money. This is not working because in a bear call spread, we like it when stocks go down a little, nowhere fast like what it was doing. It can even go up a little, but just don't cross that red line. That is the do not cross, the Maginot line. Do not go above there. That's where our bear calls are sitting. It just didn't go up there. It just smashed it. So what are we going to do about that? We could just stop ourselves out, maybe lose like $1, $2.50 a share. It's not the end of the world, but gosh, I really hate losing money if I can try to fix it. So here's what we're going to do. We're going to close that credit spread. It's going to cost us $3.18 to close that trade. It's been clearly run over. The stock is broken out to new highs. There was huge volume. You can't see it, but massive volume. This thing is going higher from a probability perspective. So where does that leave us? Well, we took in 58 cents when we initiated the credit spread, but it cost $3.18 to buy it back. Gulp, $2.60 a share loss. That's $260 a contract. 10 contracts, that's $2,600. That hurts a little bit. Now here's where that trading plan comes into play, really important. The contingency exit plan must be in place before the trade is ever initiated. So when the poop hits the fan, we are not deer in the headlights. We will act instead of react. The stock does indeed gap higher. It then consolidates and then starts to bust out to new highs. I'm not going to get super granular here, but that's triggering a buy signal. By the way, if you want to know what those yellow dotted lines are, they're 2 standard deviation John Bollinger bands. So we got back inside the bands. The overbought condition is gone. We're now running higher. Simple analysis, new highs were set. That triggers a buy signal off of a major gap higher. And then what happened? It actually pulled back a day, and then it resumed its uptrend. So here's what we do. You can see the timeline at the very bottom of your screen. And once we moved up, we went out, and what we could do is buy something like a 3-month or 2-month long call, something like that, as an example. You can do 1-month long calls, but let's just say we go out beyond 30 days. And we're going to pay $3.35. So we've already lost $2.60 a share on the credit spread, but we got to get out of that. It's a dead duck. It's over. But because we're moving higher, we're going to go directional. We're going to pay $335 a contract. And what happens? Now we're quite happy. The long call is now worth $6.80 a share. That's a profit of $3.45. So where does that put us in the overall trade? It's actually gonna allow us to make some money. We've adjusted according to our exit plan. If bear calls get run over, we can then become directionally bullish if we want to. The initial trade was 58 cents a share credit. We closed for a loss of 263. We added a long call for 335. The net result, 72 cents share of profit. Now I get asked a lot, if I go back 2 slides, how do you know when to close the long call? There's no set perfect number. For example, I truly do believe if I have a losing trade and I can just get it back to break even, I will jump up and down because here's that corny saying, I won by not losing. However, I also like to be a greedy little pig, and I don't mind squealing every once in a while. So if I have a stock that is really bullish and it just keeps marching above a moving average, who am I to say, okay, I want to sell it now and just cash out? I'll let it keep going until I get a profit, or maybe even more. So sure, we can use trailing stops and just let this thing keep running before it finally gets back below a moving average over here. You can actually tailor that particular exit just to you if you want. But again, break even, I'm happy. If I can get a winner, that's even better. And what we can even do is close most of the position and then maybe just leave one long call out there. And in terms of quantity, I didn't cover that, but let's assume that initially we did 5 contracts of a bear call spread. What I would do then is add 5, it was here, 5 directional long calls, okay? So it's usually a 1-to-1 type of adjustment. So again, we adjusted the plan. Yes, we were able to still produce a winner. And in fact, it turned out to be higher than our initial profit target in the trade. When that happens, it's even better. Now, I'm not accounting for taxes or commissions. You should consider getting at a low-cost broker. There's plenty of them out there right now. All right. So beyond the simple yet powerful strategy that I demonstrated, we did just a stock position for stock traders out there that know what long puts are. We also did a more advanced application where it was a credit spread. The stock went bonkers higher, and there was still an opportunity to try to go and make money, get a win. Again, super important that we find stocks that like to trend. If stocks are jumping beans like a 5-year-old on a sugar rush, they're really hard to predict. It's like herding gerbils. It's tough. And that's our specialty at Market Tamer, where we will teach you how to adjust trades. Whether it's bull puts, bear calls, straddles and strangles, which I consider to be more earnings related or fixed news event related, we can adjust covered calls too. We can do ratio back spreads. We can do diagonals. I'm also a fan of buying directional long-term long calls and then short calls on a monthly basis to produce a little bit of income. I find that to be a fantastic strategy as well. So you don't need to master them all. You can just start with pick one strategy, and then go to 2, and then go to 3. So when I was chatting with Jeanette and the team, they asked if I could do anything special for you guys, and I was like, absolutely. So I'm going to give you guys an opportunity to join us, and I'm going to make it, and this is the special part, completely unconditional. You don't have to do a thing, money back guarantee. Meaning that you join us, you have 30 days, and if you're like, it's not for me, you don't have to even call us. Just send us an email and we'll refund your purchase. So it's absolutely zero risk. So here's what our offer is for you today. I'm going to give you access to 40 on-demand videos. In the very beginning of today's session, I talked about, my struggles when I first began trading. I literally gave up twice. So the third time was the literal charm. I could not believe how hard everybody was making it sound. I spent what I consider to be an obscene amount of money on buying these courses. At that time, they were still on TV. I was buying them over the internet. And I was like, this is ridiculous. No one's making this simple. That's what we did at Market Tamer. So if you are new to options and you say, hey, I just want to learn what these puts are so I can start to, think about protecting my nest egg. Modules 1, 2, and 3 are going to be very helpful. If you said, hey, I got this, I know what that is, then you might go to the next segment where the middle 3 modules, we talk about credit spreads, we teach you what they are. And then if you say, man, I know what options are, I know what spreads are, I need to know how to adjust, you're going to find those final 3. So here they are listed out together. You can skip around. You can go wherever you want. You can go here. You can go here. We also have quiz questions. You don't have to take them, but it actually tells you where you're wrong. These videos were created with Articulate. What that means is you can actually go into these videos, type in call option, type in adjust, and it takes you right to that specific point verbally in the PowerPoint. So you can read the notes on the slide, you can hit play and watch the video. There's also some Excel spreadsheets you can download, they're free. When you're in there, you can play around with figuring out cost basis and so forth. So it's the whole package, everything I told you, and it's $147, not for 1 or 2 months, but it's actually 6 months. If you do the math on that, you're going to get 6 months access to our videos for $24.50 a month. And if you're not happy for whatever reason within the first 30 days, just send me an email. Say, hey, cancel, thank you. That's it. It couldn't be any easier. So that's just our video on demand. It's a couple hours of education. I think, gosh, I forget. Each video is anywhere from 5 to 20 minutes. I'm sorry, each video is anywhere from 5 to 20 minutes, and there's 10 modules. So you're going to have a couple hours of content in there. It's actually more than that. It's actually quite a lot. But depending which ones you watch, you may say, hey, I only need 3-4 hours. Maybe you need 5 or 6 hours. But again, you get to play with all of this. You just go to markettamer.com/thirsty. Again, 100% money back. There's no catches. There's zero. Known Jeanette and Hubert a very long time, and they'll tell you the same thing. There's no catch. You just send us an email by day 30 and you're good. Now, here's one thing though. We're doing 50 people. When the 50 people hit, then our price goes back to the retail price. So I know there's a whole bunch of speakers on here today. I looked at what they're presenting. It looks like it's fantastic, and you're going to have a lot of fun today. So I know you're going to want to listen to everybody. But by the end of the day today, I would expect us to sell out. So write down this link, keep it handy, or if you love what you see, just go jump there now and grab it, because you're going to pay $147 and you get your money back. Now here's one other thing I want to give you guys, because I'm watching the timer here. I'm down to about 4 minutes. A few of you guys are asking is, hey, do we offer, some hands-on training? Can you follow along? Are there any live classes? The answer is yes. When you go to markettamer.com/thirsty, you're going to be given the opportunity to get what we call an upsell, an add-on into our live education component, where every Monday at noon Eastern, 9 a.m. Pacific, you're going to be with me. We'll be talking about the market outlook for the week ahead. We'll look at potentially new trade ideas. We'll talk about technical analysis. On Tuesdays and Wednesdays, you'll be with our team. Right now, Dave is doing both sessions. He'll talk about credit spreads. He'll talk about ratios, butterflies, fibs, you name it. So you actually can get 3 hands-on sessions a week. You'll get email access to us as coaches, and everything is recorded and posted to the website. And it's only $350 for 6 months. Again, you get an ironclad money-back guarantee. So you're going to have 2 opportunities. When you go to markettamer.com/thirsty, you're going to see this page, and I'll show it to you right now. This is the web page you're going to see. It tells you get your 40 on-demand videos, and it tells you have a money-back guarantee. Once you hit buy now, you'll see a second page. It'll say, hey, would you like the live coaching as well? That's $350 for 6 months. So it would be $400, take $147 plus $350, and that's $497. If you want both, you don't have to take both. You take both for $497, you still get the 30-day money-back guarantee. There's no catch, 0 catch. Just send us an email, let us know by day 30 if you want to stay on. That's all. So super low risk. I hit some questions as we were going on. I have about 2 minutes here. Yes, Jeanette and her team, they are recording this. Lots of recording questions. There are questions about the hands-on trading for BC. The answer is yes. If you do markettamer.com/thirsty and you pay the $147, the secondary page will populate and it will give you this choice where you can get the live coaching as well. The reason we separate the two is some folks that are very new to options, they just want the on-demand videos. They just want to start slow. So that's for you guys. $147 for 6 months. It comes out to $24.50 a month. It's super cheap, and you get a 30-day money-back guarantee. For those of you guys that say, man, I really like what I saw today. I want those videos, and I want the live coaching. Well, then you're going to do $147 plus the $350, and you still get a 30-day money-back guarantee on both purchases. And in terms of renewing, you're locked in at these prices for life. You'll never pay more. There was a question is, what is the retail prices? The live coaching retail price, even without the videos, is $147 a month. So without the videos at $147, it's almost $900. If you add in the videos, it's over $1,000. So you're getting over a 50% discount. So it absolutely is our best deal. You'll never see anything better. We've never offered it for less. Do you have the program from basic to advanced? BC, yes. So BC, if you're just not sure what to do, I think the lowest risk here is just to take the 147, because if you're not happy, you get your money back. But if you want live coaching, then do both. And then you can bounce around for 6 months. We don't do a year because some folks are happy after 6 months. And if you want more education, you can just do it again. So that is my time for today. I do want to stay on time. Jeanette, I just want to thank you guys. It's always a pleasure to work with you. Your folks are fantastic. I look forward to seeing you in Vegas in a couple months. And I appreciate everybody's time today. You guys are wonderful. Thanks again, and have a great weekend, everybody.